AI is moving faster than we expected. I think the 7% plus is conservative.
ARK Invest Cathie Wood,
the founder, CEO, and CIO of ARK Invest, Cathie Wood,
the queen of innovation.
Every technology revolution has been accompanied by a step function increase in GDP growth. And so here we are, robotics, energy storage, AI, blockchain technology, multi-omic sequencing. It's nothing that anyone living today has seen before.
Your prediction of getting to $1 million of Bitcoin.
That's our bull case, 1.5 million in 2030. If you look at what's happened historically, certainly the last two cycles, gold has led Bitcoin. So we think Bitcoin is getting ready for another big run.
The global economy is undergoing a transformation so dramatic that Cathie Wood argues Bitcoin should already be trading near $200,000. Converging technologies are shattering growth patterns that remained stable for more than a century, and financial markets are struggling to adapt. For decades, investors relied on predictable benchmarks and long-standing economic models, but those models are failing at high speed. Innovation is no longer unfolding at a steady pace. It is erupting in every direction, and the assumptions that once guided markets are collapsing. Bitcoin sits squarely at the center of what went wrong. While many still call it speculative, others now view it as an essential hedge against a weakening fiat system and a store of value for a generation that no longer trusts traditional institutions. The question is no longer whether Bitcoin will survive, but why the explosive move toward $200,000 failed to materialize, and what forces held it back despite its growing global acceptance. Cathie Wood of ARK Invest says Bitcoin was preparing for a massive surge, one that could still send it toward $1.5 million by 2030. But she emphasizes that the path upward is anything but smooth. Stablecoins have captured crucial market share, regulatory pressure is tightening, and geopolitical competition is intensifying across financial systems. Wood argues these forces did not invalidate Bitcoin's trajectory, they merely delayed it. This is not a routine bull run, it is a full-scale battle for the future of money itself. Let's hear directly from Cathie Wood for more insights. Please don't forget to like, subscribe, and enable notifications. Thanks for tuning in. Enjoy the rest of the video.
We have not moved off that. That's our bull case, 1.5 million in 2030. There are a few compositional changes. One, stablecoins, so especially Tether in the emerging markets, have usurped one of the roles that we thought Bitcoin would serve. And that is, we thought that before stablecoins that people would, and they would buy Bitcoin as an insurance policy against confiscation of wealth, either in the form of inflation, hyperinflation, and massive devaluations, which occur regularly in the emerging markets, or outright confiscation of wealth. And so stablecoins now serve that purpose. Stablecoins are backed effectively by the U.S. dollar, and therefore are hostage to our fiat monetary system. So that would have taken our price target down by $200,000 to $300,000. On the other side, what has happened to gold recently? Gold has doubled over the last 2 years. And has outperformed Bitcoin royally in the last year. So the digital gold role, and we think with intergenerational wealth transfers accelerating here throughout the world, that the younger generation will diversify into a digital gold option rather than the physical gold. It's more their world. And so we think that role has increased, or that the price should be supported by what has happened to gold. Now, if you look at a correlation matrix between 20 and 25, the correlation between Bitcoin and gold has been almost non-existent, 0.14. But if you look at what's happened historically, certainly the last two cycles, gold has led Bitcoin. So we think Bitcoin is getting ready for another big run. What has happened in the last few months is 10/10. So October 10th was the flash crash caused by a software glitch at Binance. And it got a lot of highly leveraged either speculators or investors way off sides. There was an automatic deleveraging that took place. About $28 billion worth of being off sides. And we're hearing that has pretty much cleared out. So we have very high hopes for Bitcoin. And talking to the team, we had a number of people on the Bitcoin brainstorm yesterday. Our thinking is, okay, stablecoins are they're serving a humanitarian purpose, this insurance policy backed by the dollar. But and consider this is the Bitcoin crowd. They believe, and I do too, that Bitcoin that its cause is freedom, financial freedom from all government oversight and so forth, and from censorship and seizure and all sorts of things. As emerging markets' wealth grows, and we think this is a global phenomenon with all these technologies, they will move towards, from a savings point of view, right now they're hand to mouth for the most part, but from a savings point of view, they will move into Bitcoin. I know that if you look at from the bottom of the bear markets, equity and crypto in late 22, Bitcoin has gone up, I think it's roughly 360%. So definitely one of the reasons was the inflation back then and fears that the Fed would not get it under control. So I think it has played the role. The question I get a lot is, wait a minute, you're expecting not inflation, but deflation. Doesn't that take away an important role that you think Bitcoin's going to play? And our answer there is, yes, Bitcoin is a hedge against inflation. It's mathematically metered to top out at 21 million. It's going up 0.8% per year right now, which will drop to 0.4%. Its supply is now rising more slowly than gold's supply, because gold miners can just go out and, they can respond to this price signal. So their mining has picked up. But what about the deflation side? Well, if you think about 08-09, which was the catastrophic deflation, threatened a global financial bust, introducing all kinds of counterparty risk. Bitcoin is a hedge against that. If you self-custody Bitcoin, you're not subject to any counterparty risk. It's yours, and it's in your wallet. So we think it's plays a very important role in both, and especially if we're right on how disruptive the world is going to be, disrupted by these 5 innovation platforms, 15 different technologies that are converging, then there's going to be a lot of chaos in the traditional world order, and there's probably going to be a lot more bankruptcies out there than many people expect.
Cathie Wood's confidence in Bitcoin is rooted in historical patterns and structural shifts underway. She points to gold's recent performance, which has doubled over the past 2 years and outpaced Bitcoin by a significant margin in the last year alone. That might sound like bad news, but Wood sees it differently. Historically, gold has led Bitcoin in every major cycle, and she believes this pattern is repeating. Gold's rally signals that Bitcoin is gearing up for its own explosive run. Wood also acknowledges that stablecoins have disrupted Bitcoin's original use case. In emerging markets, people once turned to Bitcoin as insurance against hyperinflation and wealth confiscation. Now stablecoins like Tether are filling that role because they are backed by the US dollar and facilitate easier transactions. This shift has cost Bitcoin around $200,000 to $300,000 in potential price appreciation, according to ARK's models. But Wood is not worried. She sees a bigger opportunity emerging. the digital gold narrative. As intergenerational wealth transfers accelerate globally, younger investors are choosing Bitcoin over physical gold. They understand digital assets better, and they trust Bitcoin's scarcity and decentralization more than government-controlled fiat currencies. Wood insists that Bitcoin is not just surviving this transition, it is thriving because it represents financial freedom from censorship, seizure, and government oversight. Let's watch more clips from Wood's interview.
Anyone alive today hasn't experienced anything different. And part of the reason for that is productivity growth. It moved up in the 80s and 90s, and that was a golden age for investing. It moved up, and we did sustain 3% GDP growth around the world. Not so much because of that. I mean, I think it was partly necessary for that, but also because China joined after the World Trade Organization. I think the reason they are talking like that is, you're right, we haven't been in a technology revolution before. You know, we have 5 platforms. They are converging. They involve 15 different technologies. And the reason I think many people, especially in the financial world, do not believe this is because of the way they've set up their research. They've set up their research by sector or industry or sub-industry. They've siloed those sectors and industries when technology is permeating every one of them and blurring the lines. So you almost have to set up research the way we have set it up and purposefully, and that is by these 15 technologies. And each of our analysts is researching how to understand when and how these technologies are going to scale across sectors. So no silos here. Our analysts are working together, collaborating in order to understand the massive convergences that are taking place today. You know, many people, especially in our industry, just laugh at us, when we say we think prices are going to start falling. This is another one of those, well, it's been stuck in the 2 to 3% range. We're not getting out of there. If you look at Trueflation, which is it measures 10,000 items in real time, inflation is already down to 1.2%. And yet the Fed is fighting this notion that we're up in the 2.5% to 3% range, and they're going to get it down to 2% by golly. And, you know, that's how they potentially could overdo it. But I think that within the next year, we'll see inflation below 2% and heading negative. And it is, you've got critical to that forecast is productivity growth and unit labor costs continuing to decelerate. But also we've got gasoline costs coming down. Here in the U.S., we have housing costs, rents starting to come down. At some point, people are just it's going to become consensus thinking, but it is as far away from that right now as you can get. Wealth growth is very much tied to productivity growth. And I'm talking about real wealth growth. I'm not talking about real estate and price-driven, I'm talking more about technologically enabled productivity gains. We got a taste of it, just a taste from the 80s and 90s. It was the pre-internet age, starting with the PC, then pre-internet age, and pre-mobile age. But back then, which was a magnificent time for the financial markets, wealth creation was stupendous as software for the first time unlocked. We went through a frustrating period in the 80s. I was there, where technology, it almost seemed as though it was hurting productivity. There were some people out there saying that. And then, of course, Microsoft came along and boom. And then we had the internet, boom. So that was foreshadowing what we're going to experience here. So there was, if you look at growth accelerated, not a lot, but it accelerated, certainly from the horrible 70s growth rates. Productivity was, I think, zero or negative for a good part of the 70s into the early 80s. And then we saw productivity picking up and the financial markets boomed. And inflation came down. Back then, and the reason I've thought about it so much is very early in my career, we had taken a position that inflation was going to come down. Most people thought that couldn't happen without a depression. It happened for the opposite reason. It happened because of productivity growth associated with these technologies, a sensible monetary policy as well, I will say. Productivity growth lifted unit growth. And the history, this is unlike what you would learn from Keynesian economics, which that's associated with Harvard primarily, which says growth is inflationary. Growth is not inflationary. Growth is disinflationary. And in this world we're going into, it is deflationary. Deflation in the good sense. When the price of something drops, the demand for it explodes.
When Cathie Wood looks ahead, she sees Bitcoin playing a role far beyond investment portfolios. She believes that as emerging market wealth grows, people will move from hand-to-mouth survival to genuine savings, and Bitcoin will become their primary store of value. Countries like El Salvador have already shown how Bitcoin can serve populations trapped by unstable currencies and failing institutions. Wood expects this trend to spread as innovation platforms such as AI, robotics, and blockchain converge, lifting global economic growth to unprecedented levels. Wood's forecast of $1.5 million per Bitcoin by 2030 is her bull case, assuming Bitcoin captures a significant share of the wealth currently held in gold. But she is clear that this outcome is not guaranteed. The recent market turbulence highlighted the risks. In October, a flash crash at Binance triggered automatic deleveraging, wiping out $28 billion in highly leveraged positions. Wood says the mess has mostly cleared, but it has exposed how fragile the market can be when too many players bet with borrowed money. Wood also addresses the deflation question that critics often raise. If the world is heading toward deflation rather than inflation, does Bitcoin lose its purpose as an inflation hedge? Wood says no. Bitcoin's mathematical scarcity, capped at 21 million coins, makes it valuable regardless of inflation or deflation. In deflationary crashes like 2008, counterparty risk explodes, and traditional financial institutions collapse. Bitcoin solves that problem because self-custody eliminates counterparty risk. If you hold your own Bitcoin, no bank failure or government seizure can touch it. But Wood warns that the path forward will not be calm. The world is entering the most disruptive period in modern economic history, driven by 5 major innovation platforms: robotics, energy storage, AI, blockchain, and multimodal sequencing. These technologies are converging in ways that will create entirely new industries and destroy old ones. In that chaos, Bitcoin becomes more than an investment. It becomes a survival tool. It is a hedge against the traditional world order collapsing under the weight of its own contradictions. The question is no longer whether Bitcoin will grow, but whether investors are prepared for the volatility and disruption that will accompany it. For those watching closely, this might be the chance of a lifetime, but it demands conviction and patience. Thanks for watching. Please don't forget to like and subscribe.